Silver is sitting at 93.80 to 94.50 right now. That is an 8% single-day move on a Sunday, while the Comex is dark. And the question every silver investor is asking this weekend is the same one. Is $100 actually happening Monday? And if $100 breaks, what comes after it? Here's what I can tell you right now. There are three separate engines driving this move simultaneously. Most of the coverage you are seeing this weekend is focusing on only one of them. The geopolitical story, the Iran strikes, the Strait of Hormuz. That is real and we are going to cover it. But the reason $104 is a legitimate technical target rather than a made-up number is because the other two engines, the Comex liquidity trap and the institutional target revision, are operating completely independently of what happens in Tehran tonight. You could get a ceasefire announcement in the next 24 hours and those other two engines would still be running. OG John AG here. This is financial warfare education, not hopium. We go through all three engines honestly. We cover the bear case, and we give you the specific numbers you need to watch rather than the vague predictions that are useless on a weekend when the situation is moving by the hour. Let's break it down. Segment 1, where silver actually is right now. Let me put the current situation on the table precisely. Because precision matters when everyone around you is rounding numbers and using vague language. Silver is trading in the 93.80 to 94.50 range as of Sunday, March 1st, 2026. That represents a gain of approximately 8% in a single session on Friday. To give you context for how extreme that is, silver's average daily move in a normal market is 1% to 1.5%. An 8% single session move is roughly 5 to 6 times the standard daily volatility. The intraday high on Friday tagged $94.27. The session opened near 87.75s. That is a 652 range in one day. For a market measured in ounces, that is historically extreme. Gold closed Friday at $5,278.20, up 1.82% on the session. Silver's 8% move was more than 4 times gold's percentage gain. That ratio, silver outperforming gold by 4-1 in a crisis, is the signature of a market where physical supply constraints are amplifying the safe haven demand signal. When gold goes up because of a geopolitical event, it reflects safe haven demand. When silver goes up 4 times as fast as gold in the same event, it reflects safe haven demand layered on top of a physical market that was already tight before the first missile was fired. The gold-silver ratio compressed to approximately 56 on Friday's close, and the long-term average is above 67. In previous silver bull market peaks, the ratio has compressed to between 35 and 45. If this bull market continues on its current trajectory, silver has more room to run relative to gold than at any point in the current cycle. That is the current position. Now let's look at the three engines. Segment 2, Engine 1, the geopolitical fire. Let me be precise about what is confirmed versus what is still developing, because this weekend is moving fast and separating confirmed from rumored is the most important thing you can do. Confirmed, U.S.-Israeli joint military operations, referred to as Operation Epic Fury and Operation Roaring Lion, executed coordinated precision strikes on multiple military locations across Iran. The strikes targeted military infrastructure, defense sites, and locations connected to Iran's missile program. Confirmed, the Strait of Hormuz, the 21-mile-wide passage through which approximately 20% of the world's daily oil supply transits, is facing active disruption. Iranian naval forces declared the passage restricted. Tankers are diverting. Confirmed. An OPEC emergency summit has been called in response to the escalation. Oil is moving toward $100 per barrel on supply disruption fears. Now here is the silver-specific implication of the geopolitical engine that most of the coverage is missing. Silver is not just a safe haven metal like gold. Silver is a monetary metal and an industrial metal simultaneously. That dual character means it responds to two separate demand pressures at once during a geopolitical crisis. Safe haven demand, investors fleeing equities and dollars rotating into metals. This is what drove gold's 1.82% move and contributed to silver's upside. Industrial demand preservation. When oil spikes toward $100, supply chain costs increase across every manufacturing segment. Industrial buyers of silver, solar manufacturers, EV producers, electronics companies accelerate their purchasing to lock in current prices before supply disruption cascades through their input costs. They are not buying silver as a safe haven. They are buying it because their procurement models tell them to buy before the price goes higher. Both demand pressures fired simultaneously on Friday. That double-engine response is why silver moved 4x gold in the same session. The geopolitical engine can slow down or reverse. A ceasefire announcement, a diplomatic signal, an OPEC production response that stabilizes oil. Any of those could reduce the safe haven component of silver's move, but the industrial component does not reverse on a ceasefire. Supply chain procurement decisions are not unwound overnight. Segment 3, Engine 2, the Comex liquidity trap. Now here's the engine that the mainstream financial media has almost completely missed, and it is the most structurally important of the three. A critical paper versus physical disconnect has been building at Comex for weeks before this weekend's events. Here is the specific data. Registered silver, the metal actually sitting in Comex vaults and legally available for delivery against open futures contracts, has been falling consistently. Recent registered inventory data shows figures well below 60 million ounces when this reporting was compiled. That number was 167 million ounces in October 2025. That is a decline of more than 60% in registered inventory in approximately 4 months. At the same time, the number of outstanding futures contracts, paper claims against that inventory, remained elevated going into first notice day for the March contract. Here's what that means in plain language. For every ounce of registered silver in Comex vaults, there are multiple paper claims demanding delivery. The math simply does not work if a significant fraction of those paper holders demand physical metal rather than cash settlement. Recent reports confirm a 159 million ounce sell order triggered a CME trading halt. Think about that number against the registered inventory. If registered is under 60 million ounces and a single order references 159 million, the physical backing for that paper claim does not exist in the registered category. This is what analysts are calling the Comex liquidity trap. It is not a conspiracy theory, it is arithmetic. When the number of paper claims exceeds the physical inventory backing them, and when physical buyers are increasingly demanding real metal rather than cash settlement, the paper price is forced to converge upward with the physical price rather than the other way around. Shanghai's physical premium confirms the same dynamic from the other side of the world. Chinese physical buyers have been paying a significant premium above international spot prices for weeks, not because of a war, but because their industrial demand was already overwhelming the supply available at prevailing paper prices. The Comex liquidity trap does not disappear if the Iran situation de-escalates. The registered inventory does not refill overnight. The paper-to-physical ratio does not normalize on a ceasefire announcement. This engine keeps running regardless of what happens diplomatically. Segment 4, Engine 3, the institutional target revision. The third engine is the one that tells you where the institutional money is positioned going into Monday. Deutsche Bank has signaled that the current gold-to-silver ratio of 57 presents significant upside risk to silver relative to their existing $100 price target. When a major institution says a ratio presents upside risk to our target, in plain language that means they think their target is too low and they are about to revise it higher. Billionaire Eric Sprott, one of the most respected voices in physical precious metals, has publicly warned that if the physical supply drain continues, a revaluation shock could eventually target $300 per ounce. That is not a weekend war premium estimate. That is a structural assessment of what happens when 6 consecutive years of physical supply deficit collide with a paper market that has been masking the shortage through leverage. Major banks are rapidly revising their year-end targets. When institutional models that were built on mean reversion silver get left behind by a market printing new data every session, those models get updated, and when they get updated simultaneously across multiple institutions, the capital reallocation that follows is not gradual. Every institutional desk that revised its silver target upward over the last 48 hours has a buy order sitting behind it. Those buy orders do not get executed on Saturday. They get executed when the gate opens Monday morning, and they arrive simultaneously. Compressed demand, not distributed demand. This is not retail speculation. This is institutional capital that has been watching the physical drain data, watching the swap rate inversion, watching Shanghai premiums, and has now received a geopolitical catalyst that provided the timing signal to act. Segment 5, the technical picture, why 104 is not random. Let me walk you through the specific technical levels, because this is where the $104 target comes from, and understanding the chart structure is essential to understanding how the move plays out. Silver has been forming a textbook ascending channel on the 4-hour chart. The channel represents a series of higher highs and higher lows, each pullback holding above the previous pullback, each rally making a higher peak than the previous rally. This is the structural footprint of a sustained uptrend rather than a single session spike. The key level that was broken on Friday and is now being defended is $91.33. This level was a horizontal resistance point, a price where sellers had previously overwhelmed buyers on multiple tests. When resistance breaks convincingly and holds on subsequent tests as support, it becomes what technicians call a flipped level. Former ceiling becomes floor. The $91.33 level is now the line in the sand for the bullish case. As long as silver closes above this level on a daily basis, the ascending channel structure remains intact. Above $91.33, the immediate resistance cluster is $95. This is a round number psychological level, the same type of level as $100. just one step before it. Round numbers attract both buyers who want to get in before the level breaks and sellers who take profit at psychological targets. The price action around $95 will be noisy and volatile. Expect wicks and reversals testing patience before any sustained move through it. Above $95, the ascending channel extension points directly to 104.14 as the next major structural objective. This is not a number someone chose arbitrarily. It is where the upper boundary of the ascending channel projects based on the slope and width of the channel that has been forming for weeks. The RSI, Relative Strength Index, is hovering near 70. This tells you two things simultaneously. First, the bullish momentum is extreme. RSI near 70 is not a casual drift upward. It is sustained buying pressure. Second, the market is entering territory where short-term exhaustion is a real possibility. RSI above 70 does not mean sell. It means expect high volatility, stop hunting, and violent intraday reversals as the market tests conviction on both sides before the next directional leg. Segment 6, the CoinShop Reality Check. Let me bring this from charts and macro to the ground level, because the ground level is where the real signal lives. Right now, while institutional desks are revising targets and technical analysts are drawing channel projections, Harry at your local coin shop is dealing with a very different reality. On Friday afternoon, before the full scale of the geopolitical developments became clear, coin shops were already reporting the same split picture we have been tracking for weeks. Front cases: American Silver Eagles, Mercury Dimes, pre-1964 90% silver, sold out or selling instantly at any price. Backrooms: sterling silverware, bulk junk silver. Backing up, refiners delaying pricing. That split still exists this Sunday morning. The Eagles that were gone from Harry's case on Friday have not been restocked. The refiners who were delaying pricing on sterling silver last week have not accelerated their processing because of what happened in Tehran. Here's what Monday morning looks like for Harry. He opens. He sees the silver chart. He gets phone calls from people who have been sitting on the sidelines asking if he has Eagles. He tells them what his inventory actually is. And for a significant number of those calls, the answer is no. The retail layer arriving Monday is not going to find unlimited physical silver at 93.66. The online dealers, APMEX, JM Bullion, SD Bullion, are either going to be sold out of key items or are going to have adjusted their premiums to reflect a market where every buyer wants in and no seller wants out. The CoinShop reality is not a technical level. It is a physical confirmation that the structural story the data has been telling for months is playing out exactly where it was always going to play out. Not on a chart, but across a counter, in a transaction between a buyer who wants metal and a seller who is running low. Segment 7, the honest bear case. Now the other side. Because this is financial warfare education, and the bear case on this specific move deserves full and honest treatment. Silver is famous for violent reversals. The same high beta characteristics that gave it a 4.1 outperformance versus gold on the upside can give it a 4.1 underperformance on the downside. The January 30th crash, 31% in a single session on the Warsh nomination, was not ancient history. It was 4 weeks ago. If you bought near the $121 high that day, you are still underwater at 94s. The geopolitical premium is the most volatile component of Friday's move. Geopolitical risk premiums in commodity markets have a consistent historical pattern. They spike on the event, they sustain if the situation escalates, and they deflate rapidly if diplomatic signals emerge. The 1973 oil embargo was a years-long event. Most geopolitical spikes in metals markets resolve within days to weeks as the situation becomes clearer. If diplomatic back channels produce a de-escalation signal this weekend, a temporary ceasefire framework, an OPEC production response that stabilizes oil, the geopolitical component of Friday's 8% move could give back 3% to 4% on Monday alone. The RSI near 70 combined with a gap-up open creates a specific technical risk called a buy the rumor, sell the news reversal. The professional pattern is price gaps up at the open, retail buyers flood in, institutional sellers who positioned earlier take profit into the retail buying, price fills part of the gap, weak hands get shaken out, then the move resumes. The gap fill move to $91.33 is not a failure of the bull thesis. It is a normal technical sequence in a high volatility market. But if you bought at the gap up open expecting an immediate straight line to $104, the gap fill will feel like the thesis is wrong when it may just be the normal pattern of how these moves work. CME still has emergency tools available: margin hikes, position limits, liquidation-only trading orders. These tools do not resolve the underlying physical reality, but they can compress the paper price in the short term. They have been used before in stressed silver markets, and they can be used again. The bear case is real. The structural story is real. Both things are true simultaneously. Segment 8. What to actually watch. Here is your specific watch list for the next 48 to 72 hours, all public, all free. $91.33 on a daily close. This is the structural line. As long as silver closes above this level each day, the ascending channel and the $104 target remain valid. A daily close below $91.33 does not mean the bull market is over, but it means the near-term channel structure has been broken and a deeper retest is in progress. Watch this level on every daily candle, $95 Monday open. If silver opens Monday above $95, the institutional and retail demand compression has already begun repricing through the $95 resistance level. Watch the price action at $95 carefully. If it opens above and holds through the first hour of trading, the path to $104 is opening. If it opens above $95 and then falls back below on volume, that is the gap fill pattern described above. Comex registered silver update Monday morning. CME Group publishes daily vault reports. If registered silver shows further decline Monday after weeks of falling, the liquidity trap is deepening simultaneously with the geopolitical event. That is the most bullish combination available for the $104 target. Oil price action. If WTI crude crosses $100 Monday, the Hormuz disruption is being priced as sustained rather than temporary. That keeps the safe haven and industrial demand components of silver's move active simultaneously. If oil pulls back significantly from current levels before Monday open, some of Friday's silver move was risk premium that may partially reverse. Shanghai premium Monday night. When the Asian session opens Sunday night U.S. Eastern Time, watch whether Shanghai physical buyers are paying above or below Monday's Comex opening price. If Shanghai is paying above Comex immediately at the open, the physical market is not waiting for Western paper to catch up. Diplomatic signals. Watch for any statement from Iran, Israel, the U.S. State Department, or any Gulf state intermediary about ceasefire talks or de-escalation frameworks. These are the primary risk to the geopolitical component of Friday's move, not the technical levels, not the CME tools. Outro: I sell nothing. No courses, no Discord, no signal groups, no affiliate links. If you see my name on a paid service, it is a scam. You find me here on YouTube and on X. 3 engines: geopolitical fire, Iran, Hormuz, OPEC emergency summit, oil toward $100, Comex liquidity trap, registered inventory well below 60 million ounces, 159 million ounce orders against inventory that cannot support them, paper physical gap widening by the session, institutional target revision, Deutsche Bank signaling upside risk to $100 target, Eric Sprott warning of $300 revaluation shock, major bank targets updating simultaneously. 104.14 is not a made-up number. It is where the ascending channel that has been forming for weeks projects if the structure holds. 91.33 is not a made-up number. It is the flipped resistance level that is now the floor. These are the brackets. 91.33 below, $104.14 above. The next significant move happens in one of those two directions, and the 3 engines tell you which direction has more structural support, if you want to understand what you own and why the price behaves the way it does. Pull the CME Vault report yourself. Track the Shanghai premium yourself. Watch the OPEC emergency summit outcome yourself. The data is free. The pattern is clear. The only question is whether you are reading the data or waiting for someone on CNBC to explain it to you after it has already happened. This is financial warfare education, not advice. Do your own research. Verify everything I've shown you with your own eyes. And never confuse a paper price with a physical reality. If you watched this far with your brain turned on, drop OG John AG in the comments and tell me, are you positioned for Monday, bull or bear on the $91.33 level holding? OG out.